The US stock market has always been a powerhouse, but the post-COVID era has taken things to a whole new level. Markets rebounded aggressively after the 2020 crash, but instead of cooling down, they kept climbing. Why? Hey everyone, welcome back to the channel. In this video, we are going to break down the forces driving this rally. TINA, US exceptionalism, the rise of AI-driven investments, and whether current valuations actually make sense compared to global markets. Let's get right into it. Section 1. TINA, TINA, stands for There is no alternative. It became a key driver of post-pandemic market behavior. With central banks slashing interest rates to near zero, traditional safe investments like bonds or savings account offered almost no returns. Investors had to put their money somewhere, and stocks became the default choice. This demand pushed market valuations higher. Even when the Federal Reserve started raising interest rates in 2022, many investors still believed stocks were the best bet. Why? Because US companies, especially in tech, were still delivering strong earnings growth, keeping stocks attractive despite rising bond yields. Section 2. Another reason US market kept outperforming was US exceptionalism. This term refers to the belief that US economy and its companies are fundamentally stronger than those of other countries. Tech giants like Apple, Microsoft, and Google continue to dominate globally. The US also had a faster economic recovery post-COVID compared to Europe and other emerging markets, thanks to massive stimulus packages and a resilient labor market. Investors worldwide saw American stocks as the safest bet, keeping demand high and prices climbing. Section 3. One of the biggest drivers of stock market growth post 2020 has been artificial intelligence or AI. Companies like Nvidia, Microsoft, and Google positioned themselves as leaders in AI development, and investors started betting heavily on their future potential. This is created what's called a future premium, basically a situation where investors are willing to pay higher prices for stocks today based on expectations on massive profits in the future. But the question is, are these expectations realistic? AI is undoubtedly a game changer, but companies still need to prove they can turn innovation into sustained profit. For now, investors do seem confident, but as history shows, bubbles can be formed when hype gets ahead of actual earnings. Section 4. One way to measure if a stock is overpriced is by looking at the price to earnings or PE ratio. This metric compares a company's stock price to its emerging earnings per share. A high PE ratio means investors are paying a premium for growth expectations, while a lower ratio suggests stocks are more fairly valued. Historically, the PE ratio of S&P 500 hovers around 16 to 18, but after COVID, it shot up past 30 at times, signaling expensive valuation. Compared to other markets, the US stock prices remain even more costlier. Europe and other emerging markets have a much lower PE ratio, meaning their stocks could offer better value in terms of earnings. As of December 2024, the PE ratio of S&P 500 was 22.3, a level previously seen during the dot-com bubble and the COVID-19 pandemic. The key question is whether US companies can actually keep delivering strong growth to justify these valuations, or if we are going to see a market correction. Conclusion. Post-COVID, the US stock market has been fueled by TINA, confidence in American companies, the AI boom, and high investor expectations. But Are we in a subtle rally or are we heading towards a correction? Let me know what you think in the comments. Do US markets still have room to grow or are we overdue for a reset? If you found this video helpful, don't forget to like, subscribe, and stay tuned for more insights into economics and finance. Thanks for watching, guys, and I'll see you next time.